Hey everyone, welcome back to the Finance Talks podcast. Here's a question for you. Do you dream of retiring comfortably, maybe traveling the world, spending more time with your family, or just enjoying life without worrying about money? Sounds great, right? But here's the thing. To make that dream a reality, you need a plan. And that's where a 401k comes into play. Now, whether you're just starting your career or already halfway through it, it's never too early or too late to start thinking about your retirement savings. A 401k plan can be a powerful tool to help you build a secure financial future. Today, Priya and I are going to guide you step by step on how to start one in the USA. We're not just scratching the surface here. We'll walk you through everything you need to know so you can take control of your financial future.
Exactly, Ryan. And I want to add something here. We know retirement planning can feel overwhelming. I mean, how do you even get started? What are the rules? And what if you're worried you can't contribute much right now? These are questions we hear all the time, and let me tell you, it's normal to feel that way. But here's the good news. Starting a 401k isn't as complicated as it seems, and every small step you take today will make a huge difference down the road. Think of this podcast as your go-to guide. By the end of today's episode, you'll not only understand what a 401k is, but also how to enroll in one, how to choose the best options for your financial situation, and most importantly, how to avoid common mistakes that could cost you in the long run. Whether you're new to the workforce or already established in your career, this episode is for you.
Let's talk about why this podcast is so important. Did you know that many people miss out on building their retirement savings simply because they don't have the right information? Think about it. How many of us were taught about 401k plans in school or even during our first job? Not many, right? That lack of knowledge can lead to years of missed opportunities, like employer matching contributions or the benefits of compounding interest. This podcast is here to change that. We want to make sure you have all the tools and insights you need to take advantage of one of the best retirement savings options available. And we're not going to overcomplicate things or use confusing jargon. Our goal is to give you a clear, actionable roadmap so that by the end of this episode, you feel confident about taking that first step toward your financial security.
That's such a great point, Ryan. And here's another thing. Retirement planning isn't just about saving money. It's about peace of mind. It's knowing that when the time comes to step away from your career, you'll have the financial freedom to live the life you've always envisioned. But let's be honest. Most people don't take advantage of their 401k plan because they don't fully understand how it works, or they're intimidated by the process. That's why we're here. In this episode, we'll break it all down into simple, manageable steps. We'll talk about the basics of what a 401k is, why it's a game changer for retirement savings, and exactly how to get started. Plus, we'll share tips and strategies to maximize your savings and avoid common pitfalls. By the end, you'll have a crystal clear understanding of how to take full advantage of this powerful tool.
So what can you expect to take away from today's episode? First, we'll make sure you have a solid understanding of what a 401k is and how it works. Trust me, even if you've heard about it before, there are probably a few details that will surprise you. Next, we'll walk you through the process of enrolling in a 401k plan step by step, because let's face it, that's where most people get stuck. We'll also cover tips for managing your 401k once it's set up. Things like selecting the right investments, keeping an eye on fees, and knowing when to adjust your contributions. And let's not forget the mistakes to avoid. It's not just about what you do, it's also about what you don't do. So stick with us, because this is going to be a deep dive into everything you need to know about starting a 401k.
Absolutely, Ryan. And here's the best part. No matter where you are in your financial journey, you can start today. Maybe you've been putting this off because it feels like you don't earn enough to make it worthwhile, or you're worried about committing to a plan. We're here to show you that even small contributions can lead to big results over time. And if you're already contributing to a 401k, don't worry. We've got insights for you too. We'll talk about strategies for maximizing your contributions, understanding employer matching, and leveraging tools like catch-up contributions if you're over 50. So, whether you're a complete beginner or looking to fine-tune your plan, There's something here for you. Let's dive in and take the mystery out of starting a 401k.
All right, let's start with the basics. What exactly is a 401k? Simply put, it's a retirement savings plan that's offered by many employers in the United States. The idea is straightforward. It allows you, as an employee, to save and invest a portion of your paycheck before you even see it in your bank account. Here's how it works. When you set up a 401k, you decide what percentage of your paycheck you want to contribute. That money is automatically taken out and placed into your 401k account. Now, the real magic happens with time. This account is designed to grow through investments, like stocks, bonds, and mutual funds. And the best part? You don't need to be a financial expert. Most plans have preset options that you can choose from. So, right from the get-go, your money is working for you while you're busy earning more.
Exactly, Ryan. And what makes a 401k so attractive is the tax benefits it offers. There are two main types of 401ks: the traditional 401k and the Roth 401k. Let me break these down for you. With a traditional 401k, your contributions are made with pre-tax dollars. That means the money you put into your account is deducted from your taxable income for the year. So, if you earn $50,000 and contribute $5,000, you'll only be taxed on $45,000. This is a huge advantage because it lowers the amount of tax you owe right now. However, when you retire and start withdrawing money from your 401k, that's when you'll pay taxes on those withdrawals. On the other hand, the Roth 401k works a little differently. Here, you contribute money after taxes have already been taken out of your paycheck. But the payoff comes later. When you retire and withdraw your money, it's completely tax-free, including any investment gains. The choice between traditional and Roth often depends on your current income and where you expect your taxes to be in retirement.
That's a great explanation, Priya. And I think it's worth emphasizing why these tax benefits matter so much. When you're saving for retirement, every dollar counts. With a traditional 401k, the tax savings today can make it easier to contribute more to your plan, which means more growth potential over time. And with the Roth 401k, you're essentially locking in tax-free income for your retirement years, which is a great hedge against rising tax rates in the future. Now, some of you might be wondering, why do employers offer these plans in the first place? Well, it's actually a win-win. For employers, offering a 401k helps attract and retain top talent. And for employees, it's an easy and structured way to save for retirement. Plus, many employers sweeten the deal with matching contributions, which we'll dive into later. So, whether you choose a traditional or Roth 401k, the key takeaway here is that both options give you a significant advantage when it comes to growing your savings.
Right, Ryan. And let's also talk about the flexibility that comes with a 401k. For example, you get to choose how much you contribute, up to the IRS limits, of course. In 2024, the contribution limit is $22,500 for most people, and $30,000 if you're over 50, thanks to something called a catch-up contribution. Another great feature is how your money is invested. Most 401k plans offer a range of options, like mutual funds, index funds, and even target date funds, which automatically adjust your investments as you get closer to retirement. And don't worry if all this sounds complicated. Most employers provide guidance or default options to help you make the right choices. The best part? Once you set up your 401k, everything happens automatically. Your contributions are taken out of your paycheck, so you're saving without even thinking about it. It's like setting your financial future on autopilot, which is perfect for people who find it hard to save consistently.
Let's also not forget the long-term benefits of investing in a 401k. The money you contribute doesn't just sit there. It grows over time thanks to something called compound interest. Let me give you a simple example. Say you contribute $200 a month to your 401k, and it grows at an average annual rate of 7%. Over 30 years, that's not just $72,000 you've contributed, it's over $240,000 thanks to compounding. This is why starting early is so important. Even small contributions can grow into significant savings over time, and the sooner you start, the more time your money has to grow. But don't worry if you feel like you're starting late. There are strategies we'll discuss later to help you catch up and still make the most of your 401k. The bottom line is that a 401k isn't just a savings account, it's an investment in your future.
Exactly. And Ryan, I want to add one more thing here. Accessibility. A 401k makes it easier than ever to save. You don't have to figure out where to put your money or worry about making transfers every month. It's all automatic. Plus, many employers will even provide tools or advisors to help you understand your plan and make adjustments as needed. Think about it this way. A 401k is designed to help you succeed. It's like having a built-in system that nudges you toward a secure financial future. And as we go deeper into this podcast, we'll explore how to maximize these benefits, whether you're just starting out or looking to fine-tune your existing plan. So, if you're ready to take control of your retirement savings, stay with us. There's so much more to come.
All right, let's talk about the role employers play in a 401k plan, because they're a big part of why these plans are so effective. One of the most appealing features of a 401k is employer matching. Here's how it works. Many employers will match a portion of the money you contribute to your 401k. For example, let's say your employer offers a 50% match on the first 6% of your salary that you contribute. If you earn $50,000 a year and you contribute 6%, that's $3,000. They'll add another $1,500 to your account. That's free money just for participating. The key takeaway here is that if your employer offers matching contributions, you should always try to contribute enough to get the full match. Otherwise, you're leaving money on the table. Even if your budget is tight, contributing enough to get the match is one of the smartest financial decisions you can make.
Exactly, Ryan. And it's not just about the matching contributions. Employers also provide a range of investment options within the 401k plan. When you enroll, you'll typically see a list of funds you can choose from. These might include mutual funds, index funds, and sometimes even company stock. The goal is to give you a variety of choices so you can build a portfolio that matches your financial goals and risk tolerance. But don't worry if you're not sure what to pick. Many plans offer something called a target date fund. These are designed to automatically adjust your investments based on how close you are to retirement. It's like having a built-in financial advisor guiding your investments over time. So, not only do employers help you save through matching contributions, but they also make investing easier and more accessible.
Now let's dive into the types of 401k plans. First up is the traditional 401k, which is the most common type. This plan allows you to contribute money from your paycheck before taxes are taken out, what we call pre-tax dollars. This means that the amount you contribute reduces your taxable income for the year, which can save you money on taxes right now. For example, if you earn $50,000 a year and contribute $5,000 to your 401k, you'll only be taxed on $45,000. The trade-off is that when you retire and start withdrawing money from your 401k, those withdrawals will be taxed as regular income. This works well for many people because they expect to be in a lower tax bracket during retirement compared to their working years. So if you're looking for an immediate tax break and a way to save more today, the traditional 401k might be the right choice for you.
Great explanation, Ryan. Now let's talk about the Roth 401k, which offers a different kind of tax advantage. With a Roth 401k, your contributions are made with after-tax dollars. This means you don't get a tax break up front like you would with a traditional 401k. However, here's the big benefit. When you retire and start taking money out of your Roth 401k, both your contributions and any investment earnings are completely tax-free. This can be a game changer, especially if you think tax rates might be higher in the future, or if you expect your income in retirement to be similar to or higher than what it is now. The Roth 401k is especially popular among younger workers or those who have a long time until retirement because the tax-free growth on investments over decades can be significant. Choosing between the traditional and Roth options really depends on your current financial situation and your expectations for the future.
And then we have the solo 401k, which is a fantastic option for people who are self-employed or own a small business with no employees. This plan is designed to give individuals the same kind of robust retirement savings opportunities that larger employers provide for their employees. What makes the solo 401k unique is its higher contribution limits. Here's how it works. As both the employee and the employer of your business, you can contribute in two ways. First, as an employee, you can contribute up to the annual limit, $22,500 in 2024, or $30,000 if you're 50 or older. Then, as the employer, you can contribute an additional amount based on your earnings, up to a combined total of $66,000 in 2024. That's a huge opportunity to save aggressively if you're self-employed and don't have access to a traditional employer-sponsored plan.
Exactly, Ryan. And what's great about the solo 401k is its flexibility. You can choose whether to set it up as a traditional 401k, a Roth 401k, or even a combination of both, depending on your tax strategy. Plus, it allows for loans in case you need access to your funds temporarily, which isn't always an option with other retirement plans. The solo 401k is ideal for freelancers, consultants, or small business owners who want to save for retirement without sacrificing the potential for high contributions. It's proof that being self-employed doesn't mean missing out on powerful retirement savings options. So, whether you're employed by a company or running your own show, there's a 401k plan tailored to your needs.
All right, let's break down how a 401k grows over time, starting with the most basic element, contributions from your paycheck. When you enroll in a 401k, you decide what percentage of your salary you want to contribute. Let's say you choose 6% and you earn $50,000 a year. That's $3,000 annually that goes straight into your 401k. The best part is, this happens automatically. You don't have to think about transferring money or remembering to save. It's built right into your paycheck. This regular, consistent saving is key because it ensures you're always setting money aside, regardless of market conditions or your spending habits. And remember, even small contributions add up over time. The earlier you start, the more you'll benefit from compound growth, which we'll explain shortly.
That's a great start, Ryan. But let's not forget about one of the biggest advantages of a 401k, the employer match. This is essentially free money that your employer contributes to your 401k to incentivize you to save. For example, many employers will match 50% of your contributions up to 6% of your salary. So, if you're contributing $3,000 a year, your employer might add another $1,500. That's a 50% return on your money before it's even invested. It's important to note that not all employers offer matching, and the details of the match can vary. Some may require you to work for the company for a certain period, called a vesting period, before you own the employer contributions. But if your employer does offer a match, it's one of the easiest and most impactful ways to grow your 401k. Always aim to contribute at least enough to get the full match. It's like leaving free money on the table if you don't.
Now, let's talk about the real engine behind 401k growth, investment returns, and compound interest. When you contribute to a 401k, that money doesn't just sit in a bank account. It gets invested in things like mutual funds, index funds, or bonds, depending on the options you choose. Over time, these investments have the potential to grow, and the returns you earn are reinvested, creating a compounding effect. Here's a simple example. Let's say you invest $10,000, and it grows by 7% in a year. At the end of the year, you have $10,700. Next year, that 7% growth isn't just applied to your original $10,000, it's applied to the $10,700. Over time, this snowball effect can lead to exponential growth. The earlier you start investing, the more powerful this compounding becomes. That's why we always emphasize starting as early as possible, even if you can only contribute a small amount.
Exactly, Ryan. And here's another way to think about it. compounding rewards, patience, and consistency. Even if the market experiences ups and downs, staying invested allows you to ride out those fluctuations and benefit from long-term growth. Historically, markets have trended upward over time, which means your 401k has the potential to grow significantly if you leave your money invested. It's also worth noting that your 401k can grow even more if you increase your contributions over time. For example, you might start by contributing 3% of your salary and then increase it by 1% each year. Combine that with employer matching and the power of compounding, and you're looking at a retirement fund that could grow much larger than you initially imagined. The key takeaway? Regular contributions, employer matches, and compounding are your best allies for building a secure financial future.
Let's talk about one of the biggest reasons you should start a 401k, the tax benefits. Taxes play a huge role in how much of your money you actually get to keep, both now and in retirement. A 401k offers a way to optimize your tax situation, and it does this through two main options: the traditional 401k and the Roth 401k. Let's start with the traditional 401k. This plan lets you contribute pre-tax dollars, which means the money you put in reduces your taxable income for the year. For example, if you earn $60,000 and you contribute $6,000 to a traditional 401k, you'll only be taxed on $54,000. This not only lowers the amount you owe to Uncle Sam, but also gives you more take-home pay to work with. It's a fantastic way to save for retirement while getting an immediate tax break today.
Exactly, Ryan. And that immediate tax break is one of the reasons why the traditional 401k is so popular, especially for people in higher income brackets. But let's not forget about the Roth 401k, which takes a different approach. With a Roth 401k, your contributions are made with after-tax dollars, so you don't get a tax deduction up front. However, the magic happens when you retire. All the money you withdraw from a Roth 401k is completely tax-free. This includes your contributions and any investment earnings. Think about how powerful that is. Imagine you're in retirement and you need to withdraw $50,000 from your Roth 401k. Because it's tax-free, you get to keep every penny of that $50,000. No taxes, no surprises. This is especially beneficial if you expect tax rates to be higher in the future, or if you're currently in a lower tax bracket and don't mind paying taxes on your contributions now. It's all about playing the long game and deciding what works best for your situation.
You're absolutely right, Priya. And the beauty of having both options, traditional and Roth, is that you can customize your strategy based on your financial goals and current situation. For example, if you're early in your career and earning a lower salary, you might lean toward the Roth 401k. Paying taxes now while you're in a lower tax bracket means you can enjoy tax-free withdrawals later when your income and tax rate might be higher. On the flip side, if you're in your peak earning years, the traditional 401k can help you maximize your tax savings today. By lowering your taxable income, you could potentially save thousands of dollars in taxes this year, which might give you more room in your budget to invest or cover other expenses. The key is to think about both your current and future tax scenarios when deciding which option is right for you.
And let's not forget that you don't have to pick just one. Many employers offer the flexibility to split your contributions between a traditional and a Roth 401k. This strategy, called tax diversification, allows you to hedge your bets against future tax uncertainties. By having both pre-tax and after-tax savings, you'll have more control over your taxable income in retirement. For instance, if you retire and need to keep your income below a certain threshold to qualify for specific benefits, you can withdraw from your Roth 401k without increasing your taxable income. On the other hand, if you expect lower expenses in retirement and want to minimize your tax bill now, the traditional 401k contributions could be more advantageous. The point is, a 401k isn't just a savings plan. It's a strategic tool for managing your taxes both now and in the future.
And Priya, I think it's also important to emphasize how these tax benefits can amplify your savings over time. With a traditional 401k, the tax break you get up front might allow you to contribute more than you otherwise could, which means more money working for you in the long run. And with a Roth 401k, the tax-free growth on your investments can be a game changer, especially over decades. For example, imagine contributing $5,000 a year to a Roth 401k starting at age 25. With an average annual return of 7%, that money could grow to over $1.1 million by age 50-65, and every penny of that would be tax-free. That's the kind of advantage a Roth 401k offers. So whether you choose traditional, Roth, or a mix of both, the tax benefits of a 401k are designed to help you save smarter and achieve a more secure retirement. Let's talk about one of the best features of a 401k, the employer match. Now, this is often described as free money, and for good reason. Think about it. Your employer is essentially giving you extra money just for saving for your own future. How often does that happen? Here's how it works. Employers typically match a percentage of your contributions up to a certain limit. A common example is matching 50% of the first 6% of your salary that you contribute. Let's break that down with some numbers. Say you earn $50,000 a year, and you decide to contribute 6% of your salary, which is $3,000. If your employer offers a 50% match, they'll contribute an additional $1,500 to your 401k. That's a 50% return on your money before you've even invested it. Who wouldn't want that?
Exactly, Ryan. And what's even better is that the employer match accelerates your savings in a way that's hard to match with other financial strategies. Let's look at the same example. You're putting in $3,000 and your employer adds $1,500. That means you've got $4,500 working for you in your 401k in just 1 year. Over time, this additional contribution can compound and grow significantly, especially when invested wisely. And here's a tip for our listeners. Always contribute enough to get the full match if your employer offers one. It's essentially a 100% guaranteed return on the portion they match. Even if you're on a tight budget and can't contribute much, at least aim to meet the match limit. Otherwise, you're leaving free money on the table, and trust me, you don't want to miss out on that.
Absolutely, Priya. And let's also talk about vesting, because this is an important detail people often overlook. When employers contribute to your 401k, those contributions may not be fully yours right away. This is where the concept of a vesting schedule comes in. A vesting schedule is the timeline over which you gain ownership of your employer's contributions. For example, your employer might have a 3-year vesting schedule, meaning you'll need to stay with the company for 3 years to fully own the match they've contributed. If you leave before that, you might only keep a portion or none of their contributions depending on how long you've been there. The key takeaway? If you're planning to leave a job, it's worth understanding how much of your employer's contributions are vested so you don't miss out on that extra money.
That's a great point, Ryan. And I think it's also worth mentioning how the employer match fits into your overall financial strategy. For many people, the match can make a significant difference in how much they're able to save for retirement. Let's say your employer offers a generous match. By contributing just enough to meet the match limit, you're essentially doubling the money going into your 401k in some cases. This is why it's so important to prioritize contributions to your 401k, especially if you have employer matching available. Even if you're working on paying off debt or managing other financial goals, at least contribute enough to get the full match. It's one of the easiest and most effective ways to build your retirement savings without putting in a ton of extra effort.
All right, let's dive into one of the most powerful concepts in retirement savings, compounding returns. This is the secret sauce that makes starting a 401k early so important. Compounding happens when your investment gains start earning their own returns. In other words, you're not just earning money on what you contribute. You're earning money on the money your investments have already made. Here's why that matters. The earlier you start, the more time compounding has to work its magic. Let me give you an example. Imagine you invest $200 every month into your 401k. If your investments grow at an average annual return of 8%, after 30 years, you'll have about $300,000. But here's the kicker. You only contributed $72,000 of that. The remaining $228,000? That's all growth from compounding. Isn't that incredible?
It really is, Ryan. And what's amazing is how much of a difference just a few years can make. Let's take your example and add a twist. Imagine two people. One starts saving $200 a month at age 25, and the other starts at age 35. Both invest until they're 65 with the same 8% return. The person who started at 25 ends up with around $300,000, like you mentioned. But the person who waited 10 years to start? They'll only have about $132,000. That's nearly half the amount, even though they were saving the same amount each month. Why? Because the person who started earlier gave their money more time to grow. This is why we always emphasize starting as early as possible, even if it's just a small amount. Time is your biggest ally when it comes to compounding.
That's such a great point, Priya. And for our listeners who might feel like they're starting late, don't worry, it's not too late to benefit from compounding. Even if you're in your 40s or 50s, contributing to a 401k can still have a big impact, especially when you combine contributions with employer matching and tax advantages. For example, if you're able to max out your contributions and take advantage of catch-up contributions after age 50, you can significantly boost your savings in the years leading up to retirement. And remember, every dollar you save today will continue to grow and compound over time. The key is to start now, no matter where you are in your financial journey.
Exactly, Ryan. And I think it's also important to mention the role of consistency in compounding. It's not just about starting early, it's about contributing regularly. Even during market downturns, sticking to your contributions allows you to take advantage of lower prices, which can lead to even greater growth when the market recovers. And here's something to think about. Compounding doesn't care about how much you start with. Whether it's $50 a month or $500 a month, the principle is the same. The money you contribute today will work for you tomorrow and beyond. So, for anyone listening, don't get discouraged by thinking you need to contribute a huge amount. Start with what you can and let compounding do the rest.
Let's talk about one of the biggest misconceptions we hear all the time. I don't earn enough to save. This mindset is more common than you'd think, especially among people just starting out in their careers or those managing tight budgets. And while it's understandable to feel that way, the truth is, even small contributions can make a huge difference over time. For example, let's say you can only afford to contribute $50 a month to your 401k. It might not sound like much, but with an average return of 8%, that $50 a month could grow to over $75,000 in 30 years. That's the power of consistency and compound growth. Plus, if your employer offers matching contributions, that $50 could effectively double. The key takeaway? It's not about how much you start with, it's about starting and building the habit of saving.
Exactly, Ryan. And I think it's also important to challenge the idea that saving only makes sense when you can contribute a lot. Small steps matter just as much, especially when you're early in your career. By starting with even a small percentage of your paycheck, say 2% or 3%, you're setting a foundation. Over time, you can gradually increase your contributions as your income grows or your financial situation improves. One strategy I always recommend is to increase your contribution rate whenever you get a raise. For instance, if you get a 3% raise, try directing 1% of that into your 401k. You'll still see an increase in your take-home pay, but you're also boosting your savings without feeling the pinch. The most important thing is to start, even if it feels small. Because when it comes to saving for retirement, every little bit counts.
Now let's tackle another common misconception. I'll wait until I'm older. This one is tricky because it's easy to think, I've got plenty of time to save for retirement, especially when you're in your 20s or 30s. But here's the reality. Delaying even a few years can cost you significantly in the long run. Let me give you an example. If you start saving $200 a month at age 25 with an 8% return, you'll have around $300,000 by age 55. But if you wait until you're 35 to start, you'll only have about $132,000. That's a difference of $168,000 just because you delayed by 10 years. The earlier you start, the more time compounding has to work its magic, and the less you'll need to save later to reach the same goal.
Ryan, that's such an important point. And I want to add this. Life doesn't get any less expensive as you get older. Between mortgages, kids, healthcare, and other responsibilities, saving often becomes harder, not easier. Starting early, even with small contributions, gives you a head start that can make all the difference later on. And here's the thing. Starting early doesn't just help with compounding. It also builds momentum. Once you see your savings grow, you're more likely to stay committed and even increase your contributions. So for anyone listening who's thinking, I'll wait until next year, or I'll start when I get a raise, remember that every year you wait is a year of growth you're giving up. Start now, even if it's a small amount, and let your money start working for you.
The first step in starting a 401k plan is to check with your employer. This might seem obvious, but it's an essential step that sets the foundation for everything else. Most companies that offer a 401k provide the details in your employee benefits package, which is often included in your onboarding materials or available on your company's intranet. If you're not sure whether your company offers a 401k, the easiest thing to do is contact your human resources department. HR can give you all the details about the plan, including whether the company offers matching contributions, what investment options are available, and how to get started. Some employers automatically enroll you in the plan unless you opt out, so check even if you're unaware.
Exactly, Ryan. And I want to add that when you're reaching out to HR or reviewing your benefits package, pay close attention to the specifics of the plan. For instance, does your company have a vesting schedule for employer contributions? How much does the company match, if anything? And what are the investment options and associated fees? These details will help you make informed decisions about how to structure your contributions. But here's an important point for those whose employers don't offer a 401k. If your company doesn't have a plan, don't panic. There are alternatives. For example, you could open an individual retirement account, or IRA. With a traditional IRA, you'll get similar tax-deferred growth, and with a Roth IRA, you'll enjoy tax-free withdrawals in retirement. If you're self-employed, a solo 401k might be the way to go, offering higher contribution limits and flexibility.
Great point, Priya. And for those who might be considering alternatives like IRAs, it's worth noting the key differences. For example, 401ks typically have much higher contribution limits than IRAs. $22,500 for 401ks in 2024 versus just $6,500 for IRAs. This means you can save a lot more with a 401k if your employer offers one. And don't forget about the employer match, which is essentially free money you won't get with an IRA. So, even if your company's 401k plan isn't perfect, maybe the fees are higher than you'd like or the investment options are limited, it's still worth participating if there's a match involved. Once you've contributed enough to get the full match, you can explore other investment options like an IRA for additional savings.
Absolutely, Ryan. And here's something else to keep in mind. Taking the initiative to understand your 401k options is empowering. Retirement might seem like a far-off goal, but the decisions you make today will have a huge impact down the road. If your employer offers a 401k, take advantage of it. It's one of the easiest and most effective ways to save for your future. For those whose employers don't offer a plan, alternatives like IRAs or even brokerage accounts can still help you build wealth over time. The important thing is to start somewhere. Don't let the absence of a 401k plan be an excuse to put off saving for retirement. Instead, explore your options and create a plan that works for you.
Once you've confirmed that your employer offers a 401k plan, the next step is to understand the details of how it works. Let's start with the matching contributions policy, because that's one of the most valuable aspects of many 401k plans. Employers often match a percentage of what you contribute, up to a certain limit. For example, they might match 50% of your contributions, up to 6% of your salary. If you earn $50,000 a year and contribute 6%, that's $3,000, they'll add an extra $1,500. This is essentially free money, and it's one of the fastest ways to grow your retirement savings. The key is to contribute enough to take full advantage of the match. Otherwise, you're leaving money on the table.
Exactly, Ryan. But here's something people sometimes overlook: the vesting schedule. This determines how long you need to stay with your employer to fully own the money they contribute as part of the match. For example, some companies have immediate vesting, which means their contributions are yours from day one. Others might have a graded schedule, where you earn ownership gradually over a few years, or a cliff schedule, where you only get the employer match if you stay for a certain period, like 3 years. It's important to understand your company's vesting policy, especially if you're considering leaving your job. If you're not fully vested, you might forfeit some or all of the employer's contributions. So when you're reviewing your plan options, ask HR or check your plan documents for the vesting schedule. It's a key piece of the puzzle.
Great point, Priya. Now let's talk about another critical factor: investment options and fees. Most 401k plans offer a variety of investment choices, such as mutual funds, index funds, and target date funds. Each of these options has its own risk level and potential for returns. For example, mutual funds might offer a mix of stocks and bonds, while target date funds adjust their risk profile automatically as you get closer to retirement. But here's the thing: fees matter. Every investment option in your 401k has an expense ratio, which is the percentage of your assets that go toward covering the fund's costs. Even a small difference in fees can have a big impact over time. For instance, a fund with a 1% expense ratio will cost you significantly more than one with a 0.1% ratio over the course of 30 years. So, when you're choosing your investments, pay attention to both the potential returns and the associated fees.
Absolutely, Ryan. And for anyone feeling overwhelmed by the investment options, don't worry. You're not alone. Many plans offer tools and resources to help you decide, including risk assessment questionnaires and even access to financial advisors. And if you're unsure where to start, target date funds are a great option. They're designed to simplify the process by automatically adjusting your investments based on your expected retirement date. The most important thing is to take the time to understand your plan. Matching contributions, vesting schedules, and investment options all play a role in how effectively your 401k can grow. By being informed, you'll be in a much better position to make decisions that align with your financial goals. Remember, this is your retirement. It's worth taking the time to get it right.
Once you've understood your plan's basics, the next step is deciding whether to contribute to a traditional 401k, a Roth 401k, or a mix of both. This choice largely depends on your current financial situation and your expectations for the future. Let's start with the traditional 401k. With a traditional 401k, you're contributing pre-tax dollars. This means that the money you put in reduces your taxable income for the year. For example, if you earn $60,000 and contribute $5,000 to a traditional 401k, you'll only be taxed on $55,000. This immediate tax benefit can make a big difference, especially if you're in a higher tax bracket. However, there's a trade-off. You'll pay taxes on your withdrawals in retirement. This option is often best for people who expect to be in a lower tax bracket when they retire, which is common for many people as their income decreases.
Exactly, Ryan. Now, let's talk about the Roth 401k. This works a little differently. With a Roth 401k, you're contributing after-tax dollars, so you don't get a tax break up front. However, the major advantage is that when you retire, your withdrawals, including both your contributions and any investment growth, are completely tax-free. This can be a huge benefit if you expect your earnings and tax rate to increase over time. For instance, if you're in your 20s or 30s and just starting your career, your income is likely to grow as you advance. In that case, paying taxes now while you're in a lower tax bracket might make more sense. Plus, with the Roth 401k, you're effectively locking in today's tax rates for future withdrawals, which is a great hedge against the possibility of higher tax rates down the line.
That's a great point, Priya. And what's nice about having both traditional and Roth options is that you can customize your strategy. For example, some people choose to split their contributions between the two. This way, they get the immediate tax benefit of the traditional 401k, while also building a pool of tax-free income for retirement with the Roth 401k. Think of it as diversifying your tax strategy. By having both pre-tax and after-tax savings, you'll have more flexibility in retirement. For instance, if you need to withdraw funds but want to avoid bumping yourself into a higher tax bracket, you can take money from your Roth 401k. Or, if your tax rate is low in a particular year, you can withdraw from your traditional 401k and pay less in taxes. It's all about giving yourself options.
Absolutely, Ryan. And I think it's important to remind our listeners that there's no one-size-fits-all answer here. The choice between traditional and Roth depends on your current income, your expected future income, and your overall financial goals. For example, if you're closer to retirement and your income is at its peak, the traditional 401k might be the better choice because of the immediate tax savings. On the other hand, if you're young or expect significant career growth, the Roth 401k could be more advantageous. And don't forget, if your employer offers a match, that portion typically goes into a traditional account, even if your contributions are Roth. So you'll likely end up with a mix of both types anyway. The key is to evaluate your situation and make the choice that aligns with your long-term goals.
Now that you've chosen between traditional and Roth 401k options, the next step is deciding how much to contribute. The first rule of thumb is simple: aim to contribute at least enough to get the full employer match. This is crucial because, as we've mentioned before, the employer match is essentially free money. If your employer matches 50% of the first 6% you contribute, and you earn $50,000, contributing 6% means your employer will add $1,500 to your account. That's a 50% return on your contributions before investments even come into play. If you're on a tight budget, start by contributing just enough to meet the match, even if that's all you can afford initially. Over time, as your income grows or you get a raise, you can gradually increase your contributions. The important thing is to take advantage of the match from day one.
Exactly, Ryan. And for anyone wondering how much you're allowed to contribute, let's go over the IRS limits for 2024. You can contribute up to $22,500 to your 401k if you're under age 50. If you're 50 or older, you're eligible for something called catch-up contributions, which let you contribute an additional $7,500, bringing your total limit to $30,000. Now, I know those numbers might sound intimidating, especially if you're just starting out. But remember, you don't have to max out your contributions right away. Start with what you can afford, even if it's just a small percentage of your paycheck. What matters is getting into the habit of saving. Over time, you can increase your contributions. Many plans even allow you to set up automatic annual increases, so your contribution rate goes up by 1% or more each year without you having to think about it.
That's a great tip, Priya. And for those who are unsure how much they should contribute beyond the employer match, it helps to think about your long-term retirement goals. Financial advisors often recommend saving at least 15% of your income for retirement, which includes both your contributions and any employer match. For example, if your employer contributes 3%, you'd aim to save an additional 12% yourself, but don't feel overwhelmed if you can't hit that number right away. The key is to start where you are and work your way up. If you're currently saving 3%, try increasing it to 4% next year, then 5% the year after that. Small, incremental increases can make a big difference over time without putting too much strain on your budget.
Exactly, Ryan. And I think it's important to remind our listeners that every little bit helps. Even if you can only contribute a small amount right now, you're still taking an important step toward building a secure financial future. And don't forget, the earlier you start, the more time your contributions have to grow through compounding. If you're feeling uncertain, use tools like retirement calculators to estimate how different contribution levels will impact your savings over time. Many plans also have financial advisors or online resources to help you determine the right contribution amount based on your income, age, and goals. The most important thing is to get started and commit to increasing your contributions as your financial situation improves. Saving for retirement is a marathon, not a sprint. Every step forward gets you closer to the finish line.
Now that you've decided how much to contribute, the next step is selecting your investments. This part can feel overwhelming, especially if you're new to investing, but it's easier than you think once you understand the basics. Most 401k plans offer a range of options, and these generally fall into three main categories: mutual funds, index funds, and target date funds. Let's start with mutual funds. These are diversified portfolios of stocks, bonds, or a mix of both, managed by professionals. The idea is to spread your investments across multiple assets, which helps reduce risk. For example, instead of buying shares in just one company, you're investing in dozens or even hundreds through a single mutual fund. It's a great option if you're looking for diversification without having to pick individual stocks or bonds yourself.
That's a solid start, Ryan. Now let's talk about index funds. These are a favorite for many investors because they're low cost and straightforward. Unlike mutual funds, which are actively managed, index funds are designed to track the performance of a specific market index, like the S&P 500. This means you're essentially investing in the overall market or a segment of it, rather than relying on a fund manager to pick stocks. The advantage of index funds is that they usually have lower fees, which means more of your money stays invested and grows over time. Plus, they've been shown to perform just as well, if not better, than many actively managed funds over the long term. If you're looking for a cost-effective way to invest, index funds are definitely worth considering.
Absolutely, Priya. And for those who want a simpler, hands-off approach, target date funds are another great option. These funds are designed specifically for retirement planning. You choose a fund based on the year you expect to retire, for example, a 2025 target date fund if you're planning to retire around that year. The beauty of target date funds is that they automatically adjust their risk level over time. Early on, they'll invest more aggressively in stocks to maximize growth. As you get closer to retirement, they gradually shift toward more conservative investments like bonds to protect your savings. It's like having a built-in financial advisor that adjusts your portfolio as your needs change. For many people, this set-it-and-forget-it option is a stress-free way to invest.
Exactly, Ryan. But no matter which option you choose, it's important to understand your own risk tolerance. Younger investors often have more time to ride out market ups and downs, so they can afford to take on more risk with aggressive investments like stocks. The potential for higher returns over time makes this approach worthwhile, especially when you're decades away from retirement. On the other hand, if you're closer to retirement, preserving what you've already saved becomes more important. In that case, you might prefer a more conservative portfolio with a higher percentage of bonds or other stable investments. The key is finding the right balance between risk and reward based on your timeline and comfort level. Many 401k plans offer tools or advisors to help you assess your risk tolerance and choose investments that align with your goals.
And one last tip: don't forget to review your investments periodically. Your needs and goals will change over time, and your portfolio should reflect that. For example, as you approach retirement, you might want to shift from a growth-focused strategy to a preservation-focused one. Also, keep an eye on the fees associated with your investments. Even small differences in expense ratios can add up over decades, so it's worth choosing low-cost options whenever possible. Remember, the goal is to maximize your returns while minimizing unnecessary costs. Taking the time to choose the right investments today will set you up for long-term success.
Exactly, Ryan. And for anyone feeling overwhelmed, start simple. If you're unsure, target date funds are a great default option while you learn more about investing. As you gain confidence, you can explore other options like index funds or even a mix of investments to suit your needs. The most important thing is to get started and let your money begin working for you. Over time, you'll have opportunities to adjust and fine-tune your portfolio as your goals evolve. Remember, every decision you make today brings you one step closer to a financially secure retirement. Take it one step at a time and you'll be just fine.
Now that you've decided on your contribution amount and selected your investments, it's time to officially enroll in your 401k plan. This step is straightforward, but it's essential to get everything set up correctly so you can start saving right away. The first thing you'll need to do is fill out the enrollment form. Depending on your employer, this could be a physical form or an online process through a benefits portal. The enrollment form will ask for some basic information, like your name, employee ID, and how much you'd like to contribute. If it's an online process, you'll likely find step-by-step prompts to guide you through. Take your time and review the details carefully to make sure everything is accurate before submitting.
Exactly, Ryan. And one of the most important decisions during enrollment is choosing your contribution percentage. This is the percentage of your paycheck that will be automatically deposited into your 401k. Remember, the goal is to contribute enough to get the full employer match if one is offered. For example, if your employer matches 50% of the first 6% you contribute, aim for at least 6% to maximize that benefit. If you're not sure what percentage to start with, many plans offer calculators or tools to help you estimate how much you should contribute based on your income and retirement goals. And don't worry if you can't contribute a large amount right away. You can start small and increase your contribution annually. Many plans even let you set up automatic increases, so your contributions grow over time without you having to think about it.
Once you've decided on your contribution percentage, the next step is to choose your investments. This is where the options we discussed earlier, like mutual funds, index funds, and target date funds, come into play. Your employer's plan will provide a list of available investments, and you'll need to allocate your contributions across those options. Most plans offer a default investment option, like a target date fund, if you don't want to make an active choice right away. While that's a good starting point, it's always a good idea to review all the available options and select the ones that align with your risk tolerance and financial goals. And remember, you can always adjust your investments later as your needs change.
Exactly, Ryan. And here's something to keep in mind. Don't overthink it. Enrolling in your 401k is a significant step toward your financial future, but it doesn't have to be perfect from day one. The important thing is to get started. Once you've enrolled, you'll have opportunities to review and adjust your contributions and investments as you learn more and as your financial situation evolves. After you've submitted the form or completed the online enrollment, make sure you receive confirmation that your enrollment was processed. This might be an email, a letter, or an update in your benefits portal. Double-check the details to ensure everything is set up correctly. Your contribution percentage, investment selections, and any employer matching options. From there, you're all set, and your contributions will automatically start coming out of your paycheck. It's as simple as that.
And for those of you who might feel unsure about the process, don't hesitate to ask for help. Most employers provide resources, like HR representatives or financial advisors, who can answer your questions and guide you through the enrollment process. Also, keep in mind that enrolling in your 401k is just the beginning. As your career progresses, your income grows, and your financial goals evolve, you'll have plenty of opportunities to revisit and fine-tune your plan. The most important thing is taking that first step, enrolling in the plan and starting to save. You're setting the foundation for a secure and comfortable retirement.
Exactly, Ryan. And I think it's worth celebrating this milestone. By enrolling in your 401k, you're actively taking charge of your financial future. It's not just about saving money. It's about building the life you want in retirement. Whether you're contributing a little or a lot, every step forward brings you closer to your goals. So, take a moment to acknowledge what you're doing for yourself. Retirement might seem far away, but the decisions you're making today will have a profound impact on your future. Once you've enrolled, let your 401k work for you, and keep building on this momentum.
Enrolling in your 401k is a great start, but it's not a set-it-and-forget-it situation. To make the most of your plan, you need to monitor it regularly. A good habit is to set reminders to review your 401k at least once a year. During this review, you'll want to check two key areas: your contributions and your investment performance. Start with your contributions. Have you increased your contribution rate as your income has grown? If not, this is a good time to bump it up. Even a 1% increase can make a significant difference over the long term. Many plans allow you to set up automatic annual increases, which is an easy way to stay on track without having to remember to make changes manually.
Exactly, Ryan. And when it comes to reviewing your investments, it's important to make sure your portfolio is still aligned with your financial goals and risk tolerance. For example, if you initially chose a more aggressive investment strategy because you were 30 years from retirement, you might need to shift toward more conservative options as you get closer to retiring. Also, take a close look at how each of your investments is performing. Are they meeting your expectations? If one fund isn't performing well or has higher fees than others, it might be time to reallocate your contributions. Many 401k plans offer tools or reports that show you how your portfolio is performing compared to benchmarks, so use those resources to make informed decisions.
Another key aspect of monitoring your plan is staying aware of changes in your financial situation or life circumstances. For instance, if you receive a raise or a bonus, consider increasing your contributions. Similarly, if your financial goals shift, maybe you decide you want to retire earlier than planned, you'll need to adjust your savings rate accordingly. It's also a good idea to review your beneficiaries periodically. Life events like marriage, divorce, or the birth of a child might mean you need to update who will inherit your 401k savings. It's a small detail that can have a big impact, so don't overlook it during your annual review.
That's such an important point, Ryan. And let's not forget the impact of market conditions. If there's a downturn in the market, it's natural to feel nervous, but staying invested is usually the best course of action. Avoid making emotional decisions like selling investments when the market is down. It's better to focus on your long-term goals and trust the plan you've put in place. Finally, remember that many 401k plans offer tools, calculators, and even access to financial advisors to help you make adjustments. Don't hesitate to use these resources. Regularly monitoring your plan isn't just about finding issues. It's about making sure your 401k is working as hard as possible for you. Think of it as a yearly checkup for your financial health.
And here's the best part. Monitoring your 401k doesn't have to take a lot of time. A quick annual review, maybe even during tax season when you're already looking at your finances, can go a long way. During that time, confirm your contribution rate, check your investment mix, and see if there are new options in your plan that might work better for you. Remember, your 401k is a tool to help you reach your financial goals. By staying engaged and making adjustments as needed, you're ensuring that it remains aligned with your changing circumstances. It's all about being proactive and keeping your retirement savings on track.
Exactly, Ryan. Monitoring your plan is an empowering step. It keeps you in control of your financial future. And the best part is, once you've built this habit, it becomes second nature. Each adjustment you make, no matter how small, is a step closer to the retirement you've envisioned. So, for everyone listening, set that annual reminder. Take a close look at your plan and make those necessary tweaks. Remember, your 401k isn't just a savings account. It's a dynamic tool that evolves with you. Stay consistent, stay informed, and you'll be well on your way to achieving your financial goals.
One of the biggest mistakes people make with their 401k is not contributing enough to take full advantage of their employer's match. Think of it this way. If your employer is willing to match 50% of the first 6% you contribute, that's free money they're giving you for your retirement. But if you're only contributing 3%, you're leaving half of that match on the table. Over time, that can add up to thousands or even tens of thousands of dollars in missed savings. Here's the good news. Fixing this mistake is easy. Start by contributing enough to get the full match. If your employer matches up to 6% of your salary, aim to contribute at least that amount. It's the fastest and easiest way to boost your retirement savings, and it's essentially a guaranteed return on your investment.
Exactly, Ryan. And for anyone who feels like 6% is too much to start with, don't worry. The key is to start where you're comfortable and build from there. For example, If you can only afford to contribute 3% of your salary right now, that's okay. The important thing is to get started. Then plan to increase your contribution by 1% each year. Many 401k plans even let you set up automatic annual increases, so your contribution rate goes up without you having to think about it. It's a simple, painless way to save more over time. And remember, every little bit helps. Even starting small can make a big difference when combined with employer matching and the power of compound growth.
That's a great point, Priya. And let's break it down with an example to show just how much of a difference employer matching can make. Let's say you earn $50,000 a year, and your employer offers a 50% match on the first 6% of your salary. If you contribute 6%, that's $3,000 a year, and your employer will add another $1,500. That's a total of $4,500 going into your 401k every year. Now imagine you only contribute 3% instead of 6%. That's $1,500 from you and $750 from your employer for a total of $2,250. You're leaving $1,500 of free money on the table every year. Over 30 years, assuming an 8% annual return, that could mean missing out on over $200,000 in retirement savings. The lesson here is clear: contribute enough to get the full match. It's too valuable to pass up.
That's such a powerful example, Ryan. And I want to emphasize that this isn't just about numbers. It's about your future. Missing out on the employer match doesn't just mean losing money. It means losing the opportunity to build the retirement you deserve. For those listening, if you're not sure what your employer's match policy is, reach out to HR or review your benefits package. Make it a priority to contribute enough to get the full match. And if you can't afford that right now, make a plan to get there over time. Start with a smaller percentage and increase it incrementally. Each step brings you closer to maximizing your savings and avoiding this common mistake. Remember, every dollar you contribute today is a dollar that will grow and compound for your future.
Another common mistake people make with their 401k is withdrawing funds too early. It's tempting to dip into your retirement savings when life throws you a financial curveball, but doing so can come with serious consequences. If you withdraw money from your 401k before age 59 and a half, you'll typically face a 10% early withdrawal penalty on top of the regular income taxes you'll owe. Let's break that down. If you withdraw $10,000 early, you could lose $1,000 right off the top to penalties, and if you're in the 22% tax bracket, another $2,200 goes to taxes. That means you'd end up with just $6,800 from your $10,000 withdrawal. That's a lot of money to lose, and it doesn't even account for the opportunity cost of taking that money out of your account and losing potential growth.
Exactly, Ryan. And what makes this even more concerning is that withdrawing money early doesn't just impact you in the short term, it can significantly derail your long-term retirement goals. Remember, the money in your 401k grows over time through compounding. When you withdraw funds early, you're not only losing the amount you take out, but also all the potential growth that money could have generated over the years. That's why it's so important to view your 401k as untouchable until retirement. If you're facing a financial emergency, there are usually other options to consider first, like building an emergency fund, cutting expenses, or even taking on a short-term loan. Your 401k should only be a last resort.
Priya, you bring up a great point about alternatives. It's also worth noting that many 401k plans offer provisions like loans or hardship withdrawals, which can provide access to your funds without the full penalty. With a 401k loan, you're borrowing money from your account and paying it back with interest. The good news is that the interest goes back into your 401k, not to a bank. However, there are still risks. If you leave your job before repaying the loan, you'll usually have to repay the balance quickly, or it will be treated as a withdrawal, triggering taxes and penalties. Hardship withdrawals are another option, but they're limited to specific circumstances like medical expenses or preventing foreclosure. Even then, you'll still owe taxes and sometimes penalties on the amount withdrawn.
That's right, Ryan. And I want to emphasize that while these options exist, they should only be used as a last resort. The best strategy is to avoid needing to tap into your 401k at all. That's why having a solid emergency fund, 3 to 6 months of living expenses, is so important. It gives you a financial cushion to handle unexpected expenses without jeopardizing your retirement savings. For anyone listening, the key takeaway is this: your 401k is for your future. Treat it like a sacred space for your retirement funds and explore every other option before considering early withdrawals. Protecting your 401k today means setting yourself up for financial security tomorrow.
And for those who might have already made an early withdrawal, don't worry. It's not too late to get back on track. Make a plan to replenish what you've withdrawn by increasing your contributions over time. If you're over 50, take advantage of catch-up contributions to accelerate your savings. The most important thing is to learn from the experience and prioritize keeping your 401k intact moving forward. Retirement may seem far away, but the decisions you make now will determine the kind of future you can enjoy. Staying disciplined and protecting your savings is one of the best ways to ensure you reach your goals.
Exactly, Ryan. And let's remember that life happens. We all face challenges and unexpected expenses. But having a plan in place, like an emergency fund and a commitment to protecting your retirement savings, can make all the difference. So, to everyone listening, think of your 401k as an investment in your future self. The more you nurture and protect it now, the more freedom and security you'll have when it's time to retire. Stay disciplined, stay focused, and know that every step you take today is building a better tomorrow.
One of the most overlooked aspects of managing a 401k is understanding the fees associated with your investments. While they might seem small at first glance, high fees can significantly erode your returns over time. Most 401k plans charge fees for things like administrative costs, fund management, and transaction costs. These fees are typically expressed as a percentage of your account balance, called the expense ratio. Let me give you an example. Imagine you have $100,000 in your 401k and you're choosing between two funds. One has an expense ratio of 1% and the other has an expense ratio of 0.1%. Over 20 years, assuming an average return of 7% per year, the fund with the 1% fee would cost you over $30,000 more than the fund with the 0.1% fee. That's money that could have stayed in your account and grown over time.
That's a great example, Ryan. And what's important for our listeners to understand is that even small differences in fees can have a big impact when compounded over decades. High fees are like a slow leak in your retirement savings. They might not seem like a big deal at first, but over time, they can drain a significant amount of your wealth. So, how do you avoid this mistake? Start by reviewing the expense ratios of the funds in your 401k. This information should be listed in your plan documents or online portal. Look for low-cost options, like index funds, which typically have expense ratios of 0.1% or less. Index funds are designed to track the performance of a specific market index, like the S&P 500, and they don't require expensive active management, which keeps costs low.
That's a great strategy, Priya. And for those who prefer a hands-off approach, target date funds can also be a good option. While they tend to have slightly higher fees than index funds, they still offer relatively low costs compared to actively managed funds. Plus, they automatically adjust your asset allocation over time, making them a convenient choice for many investors. Another tip is to check if your plan offers institutional class funds. These funds are designed for large investors, like 401k participants, and often have lower fees than their retail counterparts. If these options are available, they can be a great way to minimize costs and maximize your returns.
Exactly, Ryan. And I think it's also worth mentioning that while fees are important, they're not the only factor to consider when choosing investments. You want to strike a balance between low costs and strong performance. For example, if a slightly higher cost fund has consistently outperformed its benchmark, it might still be a good choice. The key is to be informed. Don't just pick a fund because it's the default option in your plan. Take the time to research your choices, compare fees, and understand how those fees will impact your savings over time. Remember, Every dollar you save on fees is a dollar that stays in your account and continues to grow.
And for anyone who feels overwhelmed by this process, don't worry. Many 401k plans offer tools and resources to help you analyze fees and make better choices. You can also consult with a financial advisor if you need personalized guidance. The important thing is to stay proactive. Check your account statements regularly to see how much you're paying in fees and compare that to the performance of your investments. If something doesn't add up, don't hesitate to make changes. Over time, these small adjustments can add up to significant savings and better results.
That's right, Ryan. And let's remind our listeners that controlling fees is one of the easiest ways to boost your retirement savings. Unlike market returns, which are unpredictable, fees are something you can control. By choosing low-cost options and staying informed, you're taking a big step toward maximizing your 401k's growth. So, to everyone listening, make it a habit to review your fees annually. It's a small effort that can make a big difference in your financial future. Remember, your money works hard for you. Don't let high fees take a bigger slice than necessary.
One of the most common mistakes people make with their 401k is failing to diversify their investments. Diversification is a fundamental principle of investing, and it's all about spreading your money across different asset classes, industries, and geographies to reduce risk. The problem with putting all your money into one stock or sector is that if that stock or sector underperforms, your entire portfolio takes a hit. For example, imagine putting all your 401k funds into technology stocks. While tech has had great growth periods, it's also highly volatile. If there's a downturn in the tech sector, your portfolio could lose significant value. By diversifying, you're essentially creating a safety net. If one area underperforms, gains in other areas can help offset those losses.
Exactly, Ryan. And diversification isn't just about avoiding risk. It's about optimizing returns, too. A well-diversified portfolio typically includes a mix of stocks, bonds, and other assets. Stocks provide growth potential, while bonds offer stability. Within stocks, you can diversify further by investing in companies of different sizes, industries, and regions. For example, you might allocate part of your portfolio to large-cap stocks, another part to small-cap stocks, and a portion to international stocks. Bonds can also be diversified between government, corporate, and municipal bonds. The goal is to create a portfolio that balances risk and reward based on your time horizon and financial goals.
That's a great breakdown, Priya. And for those who aren't sure how to achieve diversification, many 401k plans make it easy by offering options like mutual funds and index funds. Mutual funds often include a mix of stocks and bonds, providing instant diversification in a single investment. Index funds, on the other hand, track specific market indexes, like the S&P 500, which means you're investing in a broad range of companies within that index. Target date funds are another great option for diversification, especially for those who prefer a hands-off approach. These funds automatically adjust your portfolio over time, shifting from a growth-focused mix to a more conservative one as you approach retirement. They're designed to take the guesswork out of managing your investments.
Absolutely, Ryan. And I want to stress that diversification doesn't mean you have to own dozens of different funds or assets. The key is to strike a balance that fits your goals and risk tolerance. For younger investors with decades until retirement, it might make sense to have a higher allocation to stocks for growth. For those closer to retirement, a greater emphasis on bonds can help preserve capital. And don't forget about rebalancing. Over time, some investments will grow faster than others, which can throw your portfolio out of balance. For example, if stocks outperform bonds, your portfolio might become riskier than you intended. Rebalancing annually or semi-annually ensures your portfolio stays aligned with your original strategy.
And one thing to keep in mind is that diversification doesn't guarantee you won't experience losses, but it does reduce the risk of losing everything at once. It's about managing risk in a way that lets you sleep better at night, knowing your portfolio isn't overly reliant on one company, sector, or asset class. For anyone feeling overwhelmed, start with the basics. Choose a few funds that cover different asset classes, like a large cap index fund, a bond fund, and maybe a small cap or international fund. If you're still unsure, don't hesitate to consult a financial advisor or use the resources provided by your 401k plan. The tools are there to help you build a diversified and resilient portfolio.
Exactly, Ryan. Diversification is one of the simplest yet most effective strategies for protecting and growing your retirement savings. By spreading your investments across asset classes, you're not just managing risk. You're also positioning yourself to take advantage of opportunities in different markets. So, to everyone listening, take a close look at your 401k portfolio. Are you diversified enough? If not, make adjustments to ensure your investments are balanced and aligned with your goals. Remember, diversification isn't about avoiding risk entirely. It's about being smart with your choices and preparing for the unexpected.
One of the easiest mistakes to make with your 401k is setting your contribution rate once and never revisiting it. While it's great to get started, your financial situation and goals are likely to change over time, and your contributions should evolve with them. That's why it's so important to review your contributions annually. For example, if you received a raise this year, consider increasing your contribution rate. A good rule of thumb is to bump it up by at least 1% each year. It's a small change that you might not even notice in your take-home pay, but over time, it can make a significant difference in your retirement savings. And remember, many 401k plans offer automatic escalation features that increase your contribution rate annually without you having to lift a finger.
Exactly, Ryan. And let's not forget about life events that can affect your financial goals. Maybe you've paid off a car loan or reduced other expenses. Those moments are perfect opportunities to redirect some of that money toward your 401k. The more you contribute now, the more time your money has to grow through compounding. For our listeners who are closer to retirement, updating contributions becomes even more critical. If you're age 50 or older, you can take advantage of catch-up contributions. In 2024, this means you can contribute an additional $7,500 on top of the standard $22,500 limit, for a total of $30,000. Catch-up contributions are a fantastic way to boost your savings if you feel like you're a bit behind on your retirement goals.
That's such an important point, Priya. And here's another scenario to consider. If you started with a low contribution rate when you were younger, you might have been focusing on paying off student loans or saving for a house. But as those financial burdens ease, it's the perfect time to increase your contributions. Think about this. If you're contributing 6% now, increasing it to 10% or even 15% over time can have a profound impact on your retirement savings. It's especially important if you're not on track to meet your retirement goals. Use tools like retirement calculators to see how different contribution rates affect your projected savings. It's a great way to motivate yourself to save more.
Absolutely, Ryan. And let's not forget the psychological benefits of increasing your contributions gradually. By setting small, incremental goals, like raising your rate by 1% each year, you're making progress without feeling overwhelmed. Over a decade, that small annual increase could bring you from contributing 5% to 15% of your salary, which is a huge step toward financial security in retirement. And for those nearing retirement, catch-up contributions are your best friend. They give you a chance to maximize your savings during your peak earning years. If you're 50 or older and haven't been able to save as much as you'd like, this is the time to go all in. The extra $7,500 a year might seem small, but over 10 or 15 years, it can add up to a significant boost in your retirement fund.
And for those who feel like they've neglected this step, don't worry. It's never too late to get back on track. The important thing is to start now. Review your 401k contributions annually and make adjustments based on your income, expenses, and retirement goals. And if you're unsure where to start, many 401k plans offer resources like online tools or access to financial advisors to help you figure out the best contribution rate for your situation.
Exactly, Ryan. Updating your contributions is one of the simplest yet most impactful actions you can take for your retirement. Whether it's a small increase each year or taking advantage of catch-up contributions, every adjustment brings you closer to the retirement you've envisioned. So, to everyone listening, take a few minutes to review your 401k today. Are you contributing enough to meet your goals? If not, make a plan to increase your contributions gradually. Remember, your future self will thank you for every dollar you save now. It's all about staying proactive and making sure your 401k works as hard for you as you do.
One of the smartest strategies for maximizing your 401k is to increase your contributions over time. The idea is simple. As your income grows, so should the percentage you're saving for retirement. A great way to do this is by committing to raise your contribution rate by 1% each year. Let's break it down. If you're earning $50,000 and currently contributing 5%, that's $2,500 a year. By increasing your rate to 6% next year, you're adding an extra $500 to your savings. Over the course of 10 years, gradually increasing your rate to 15% could bring your contributions to $7,500 annually, 3 times what you started with. These small incremental increases are easy to implement and make a significant difference over time.
Exactly, Ryan. And what makes this strategy so effective is that you barely notice the change. A 1% increase is such a small adjustment that it's unlikely to have a big impact on your monthly budget. But when compounded over years, it can dramatically boost your retirement savings. Another great opportunity to increase your contributions is when you get a raise or bonus. Let's say you receive a 3% raise. Why not allocate 1% of that toward your 401k? You'll still enjoy an increase in your take-home pay, but you'll also be putting more money toward your future. This approach allows you to boost your savings without feeling the pinch, making it a win-win.
Priya, that's a great point. And let's not forget that many 401k plans offer automatic escalation features. This tool allows you to set your contribution rate to increase by a specific percentage each year, say 1%, without you having to manually update it. It's a set it and forget it option that ensures you're steadily saving more over time. For those who might feel hesitant to increase their contributions, think about this. Every dollar you save today has decades to grow and compound. Starting small and increasing gradually can add hundreds of thousands of dollars to your retirement fund over your career. It's a simple strategy that pays off big in the long run.
Absolutely, Ryan. And I want to emphasize that these small changes are powerful because they build momentum. Each increase brings you closer to your retirement goals. And once you start seeing the growth in your 401k, it becomes easier to stay motivated. For example, let's say you commit to increasing your contributions by 1% each year for the next decade. By year 10, you could be contributing 10% more than you are today. Combine that with any employer match, and you're looking at a substantial increase in your savings. The key is to start now, even if the increase feels small. Over time, those incremental changes will add up to something truly significant.
And for those who think they might struggle with larger contributions, remember that you can always adjust based on your circumstances. If you have a tight year financially, you can pause the increases and resume when things improve. The important thing is to make increasing your contributions a habit whenever it's feasible. Also, don't overlook windfalls like tax refunds, bonuses, or even unexpected gifts. Allocating a portion of these funds to your 401k is a great way to give your retirement savings a boost without affecting your monthly budget. Every little bit counts, and these extra contributions can make a big difference over time.
Exactly, Ryan. And let's remind everyone that increasing your contributions isn't just about the numbers. It's about investing in your future self. Every extra dollar you save today means more freedom and security in retirement. It's about creating options for yourself down the line, whether that's retiring early, traveling, or simply living comfortably. So, to everyone listening, make a plan to gradually increase your contributions. Use tools like automatic escalation, take advantage of raises and bonuses, and stay consistent. These small, intentional steps will set you up for a brighter financial future. Remember, you're building a foundation for the retirement you deserve.
One of the biggest mistakes people make when investing is trying to time the market, predicting when to buy or sell based on market conditions. It might sound appealing to pull your money out during a downturn or jump in when the market is soaring, but the truth is, even professional investors struggle to consistently time the market correctly. For most of us, it's far better to stick to a steady contribution schedule, no matter what's happening in the market. This approach is called dollar-cost averaging. When you contribute to your 401k regularly, you're buying investments at different price points over time. Sometimes the market will be up, and other times it'll be down. But the key is that you're averaging out your costs and taking advantage of lower prices during downturns. Over the long term, this strategy tends to produce solid results without the stress of trying to time the market.
Exactly, Ryan. And the beauty of dollar-cost averaging is that it removes emotions from the equation. When markets are volatile, it's easy to panic and think about pulling your money out. But history has shown that staying invested is almost always the better choice. Markets have ups and downs, but over the long term, they tend to trend upward. By sticking to regular contributions, you're ensuring that you're always in the market, ready to benefit from the recovery that typically follows a downturn. Let me give you an example. Say the market drops, and the price of your chosen fund falls from $50 per share to $40. If you're contributing regularly, you'll be able to buy more shares at that lower price. When the market recovers, those additional shares will increase in value, giving you a better return over time. It's a simple but powerful way to take advantage of market fluctuations without having to predict what will happen next.
That's a great example, Priya. And I think it's worth emphasizing just how much trying to time the market can hurt your long-term returns. Studies have shown that missing just a few of the best-performing days in the market can significantly reduce your overall gains. For instance, if you were out of the market during its top 10 days of growth over a 20-year period, your returns could be cut in half. The takeaway here is clear. Stay consistent with your contributions. Whether the market is up, down, or flat, keep putting money into your 401k. This disciplined approach ensures that you're always investing for the future, and it helps you avoid the costly mistakes that come with trying to time the market.
Absolutely, Ryan. And I want to remind our listeners that market volatility is normal. It's just part of investing. While it might feel unsettling to see your account balance dip during a downturn, it's important to focus on the bigger picture. Your 401k is a long-term investment, and what matters most is where you'll be in 20 or 30 years, not what happens over the next few months. Staying consistent with your contributions, especially during tough times, can actually give you an edge. You're buying at lower prices, which increases your potential for growth when the market rebounds. And for those who still feel nervous, tools like target date funds or diversified portfolios can help manage risk while keeping you invested. The key is to stay the course and trust the process.
And for anyone who's tempted to stop contributions during a downturn, think of it this way. By pausing or pulling out, you're locking in your losses and missing out on future gains. Instead, focus on the fact that every contribution you make during a market dip is essentially buying investments on sale. Over time, those discounted investments can provide a significant boost to your returns. So, whether the market is volatile or calm, stick to your plan. Set up automatic contributions and trust that consistent investing will pay off in the long run. Remember, your 401k is designed for the long haul, and patience is one of your greatest allies.
Exactly, Ryan. Investing isn't about avoiding the storms. It's about staying the course and letting time and discipline work their magic. Dollar-cost averaging ensures you're always participating in the market, taking advantage of both highs and lows. It's a proven strategy that simplifies investing and reduces the emotional stress of trying to time things perfectly. To everyone listening, keep contributing, trust your strategy, and focus on your long-term goals. The ups and downs of the market are just small bumps on the road to a secure and comfortable retirement. Stay consistent, stay patient, and let your 401k do its job.
Catch-up contributions are one of the best tools available for those who are 50 or older to supercharge their retirement savings. Starting in 2024, the IRS allows you to contribute an additional $7,500 annually to your 401k on top of the standard contribution limit of $22,500. That means if you're 50 or older, you can contribute up to $30,000 a year. This extra contribution can make a huge difference, especially if you feel like you're behind on your retirement goals. For example, if you start making catch-up contributions at age 50 and continue until 65, you could add an extra $112,500 to your retirement savings, not including investment growth. Combined with the power of compounding, this can significantly boost your retirement nest egg.
Exactly, Ryan. And what makes catch-up contributions so powerful is that they often come at a time when people are in their peak earning years. By age 50, many individuals have paid off significant debts, like student loans or mortgages, and are better positioned to allocate more money toward their retirement savings. Think of it as a second chance to maximize your 401k. Even if you've been saving consistently, these extra contributions can provide a meaningful boost. And if you're taking advantage of employer matching, that's even more money going into your account. The key is to prioritize these contributions and make the most of this opportunity while you're still working.
Great point, Priya. And for those who might wonder how to fit catch-up contributions into their budget, it's worth looking at opportunities like bonuses, raises, or even cutting back on discretionary expenses. Redirecting that extra income into your 401k can make a big difference without significantly impacting your day-to-day living. Let's put this into perspective with an example. If you're 55 and start contributing an extra $7,500 annually, and your investments grow at an average rate of 7%, you could accumulate an additional $150,000 or more by age 65. That's a substantial boost to your retirement savings, and it highlights just how impactful these contributions can be.
Absolutely, Ryan. And let's not forget that catch-up contributions are designed to help close the gap for those who might not have been able to save as much earlier in their careers. Life happens. Maybe you had to pause contributions for family expenses or other priorities. Catch-up contributions give you a chance to make up for lost time and secure your financial future. For anyone listening who's 50 or older, take a moment to review your 401k contributions. Are you maximizing your catch-up potential? If not, this is your opportunity to increase your savings and take full advantage of this benefit. Even if you can't contribute the full $7,500 right away, start with what you can and build from there.
And for those who might feel overwhelmed by the idea of contributing an extra $7,500 a year, remember that every little bit helps. Even if you're only able to contribute an additional $1,000 or $2,000, it's still more than you were saving before. The important thing is to do what you can and stay consistent. Catch-up contributions are a valuable tool, but they're not an all-or-nothing deal. Start small if you need to, and look for ways to gradually increase your contributions over time. The key is to make the most of this opportunity while you have it.
Exactly, Ryan. Catch-up contributions aren't just about adding to your retirement savings. They're about empowering yourself to take control of your financial future. By leveraging this opportunity, you're not just preparing for retirement. You're setting yourself up for a more comfortable and secure life. To everyone listening, if you're 50 or older, take full advantage of catch-up contributions. Talk to your HR department or financial advisor to ensure you're maximizing this benefit. It's a powerful tool, and it's never too late to make a difference in your retirement savings.